Good afternoon, and welcome from my side to another session of the 2023 Arendt UCITS webinar series. Risk management for UCITS, a risk-based approach for UCITS. And welcome also to my colleague Alexandre Brajou. Alexandre Brajou is a senior manager at Arendt Regulatory Consulting. In the team of Arendt Regulatory Consulting, Alexandre is looking into risk management, management topics, let's say really on the practical side of things, together with myself and the team from the legal side. So my name is Henning Schwabe. And I remember prior to start, in fact, the webinar that actually last year we had been already sitting together, and we had been in particular also speaking about the Ukraine crisis and the situation in particular from a liquidity risk management perspective. And nowadays, on top of this, we have the terrible situation in Israel. Obviously, I don't want now to comment from a political point of view on that, but actually it has to be considered within the risk management situation, within the, in particular, liquidity risk management side of things. In terms of table of contents, we have the liquidity risk and the liquidity management tools, as I was just referring to already, valuation risk, sustainability risk, focus on contingent convertible bonds, and last but not least, questions and answers. Now, Alexandre, if we start with the first topic, liquidity risk and LMTs, we have seen that the Financial Stability Board, FSB, has recently issued recommendations with regards to liquidity risks. What are the main points addressed in this publication from a liquidity risk management perspective?
Thank you, Henning, and good afternoon, everybody. Yes, we have seen that in July this year, the FSB made a publication, and in this publication proposed some changes to its 2017 recommendations in order to better address the structural vulnerabilities from liquidity mismatch in open-ended fund. Basically, those changes are directly following an assessment which has been performed by the FSB on its own recommendations, previously published in 2017, and it has been conducting on non-banking financial participants, including, of course, investment funds, or more especially open-ended funds, which are offering the opportunity to each shareholder to redeem the share. One of the main findings of this assessment, it has to be that, of course, currently national competent authorities in Europe are authorizing the use of liquidity management tool in both normal and stress market conditions. But for the SFB, it could be better improved, and especially in case of stress market conditions. There is a way for improvement for the FSB and to better use the LMTs in order to strengthen the resilience of open-ended fund, and especially, as I said, in case of stress market condition, as we have faced in the past with the COVID crisis, Ukrainian crisis, and as just mentioned by Henning now, the current crisis with the conflict between Palestine and Israel, potentially. Concretely, in order to do so, the FSB is making a proposal in terms of classification of open-ended fund, and basically the SFB is proposing a classification into 3 categories, which are mainly defined based on the portion of the assets of the fund invested in liquid, less liquid, and illiquid assets. And basically, for each category, the SFB is proposing, let's say, in a way to make it systematic, the use of LMT. The FSB is recommending to say to clearly define what kind of redemption frequency can be used for this specific fund, and if LMT has to be implemented on top of that as well. So definitely what we have seen in this publication is that the SFB is really encouraging national competent authorities and authorities in Europe to really promote the use of LMT, and again, especially in case of stress market condition. And additionally, the SFB is also encouraging authorities to give consideration to the use of system-wide stress testing that could help to better assess the effect of the collective selling of funds and especially the effects that it may have on the financial market, on the financial system more generally, and here again, in case of a stress market condition.
No, thanks, Alexander. I've been touching already a bit on it, but let's say a bit more practically how IFMs are expected to manage liquidity risk of their funds in order to tackle these vulnerabilities which are identified by the FSB.
Well, basically, that's another point which is highlighted by the FSB. What is expected from an investment fund manager is really to take into consideration liquidity risk during the design phase and as well during the ongoing phase of any open-ended fund. In that sense, the FSB is really making attention on drawing attention to the fact that the redemption policy of the fund, and especially open-ended fund, must be really defined and designed in accordance with the investment strategy of the fund. So it has to be taken into consideration the type of asset the fund is going to invest in. And of course, at this stage, you have to take into consideration the potential liquidity risk that may affect the assets. And here, for example, we can talk as we are covering UCITS fund, but if you have UCITS fund investing in high yield bonds or frontier market bonds, here that's specific considerations that must to be taken into considerations. And the redemption policy and frequency of the fund must be adequately designed. On top of that, of course, as it's really something that the FSB is encouraging, you can couple as well a liquidity management tool in order to ensure that you will reduce as much as possible any liquidity risk coming from redemption from your shareholders. And of course, all those things has to be properly integrated in the global risk management framework of the investment fund managers in both normal and stress market conditions.
Yes, absolutely. But you have been mentioning already now the liquidity management tools, but more concretely, what are in fact the different liquidity management tools which are available for the IFMs here in Luxembourg?
So basically, we can classify the different liquidity management tools into three different categories. The first category is the LMTs that we call anti-dilution or price-based LMTs. So here we are talking about anti-dilution levies mechanisms or swing pricing. The purpose of this LMT is in fact to transfer the liquidity cost resulting from redemption to the redeeming shareholders. As such, it could strengthen the open-ended fund resilience by, let's say, reducing the number of redemptions that it may face by, let's say, as the redeeming shareholders are knowing that there will be such mechanisms in place, it can limit a bit the increase of the redemptions. And on top of that is the idea is because sometimes you can see that if investors are redeeming first, they may take advantages to the other one which are still staying in the fund and redeeming a bit later. In that sense, and with the applications of such LMT, you are transferring a bit the liquidity cost to these first redeeming investors. The second category of LMTs is the one we are calling the quantity-based LMTs. So here we are talking about NAV suspensions or redemption gate mechanisms. Here, normally they are more used in case of stress market conditions. And here really the idea is just to limit the volume of redemptions by putting a clear threshold. Most of the case for gate we see a 10% NAV threshold applicable. But here you have to pay attention that you may have some adverse effect on this kind of LMT because, of course, such LMT has to be disclosed to investors, and you may face the fact that investors, being aware that you have such gate mechanisms, they can anticipate the redemptions. And, in fact, it can have this kind of adverse effect. And finally, the last category of LMT is the one which are the redemption in kind or the side pocketing. Those one are to be considered as used in extreme cases, but we have seen that, especially for UCITS funds, that with the Russian and Ukrainian crisis, it has been allowed by CSSF to use this kind of LMT, even for UCITS funds. Globally, all those LMTs are available for open-ended fund here in Luxembourg and UCITS as well. And here again, even the side pocketing, which was so far considered not really deemed for UCITS has been authorized on, let's say, exceptional basis by the CSSF during the last Ukrainian crisis.
Exactly. I think that was also one element which we mentioned already last year, and overall I think in terms of liquidity management tools, I think the Luxembourg market is quite solid and quite good. Now in terms of, let's say, to give a bit of an outlook also from a liquidity risk perspective, Alexander, what should we expect here with regards to the liquidity risk management for the probably coming months but also coming years? How is this going to continue?
Well, basically what we can expect is that we can expect always increasing scrutiny from the regulator on the CSSF on the liquidity risk aspect. And unfortunately, we see during the last years that we are facing several financial crises on stress market conditions, and each time we can see that liquidity risk is a key risk which is really materializing in case of stress market conditions. So basically we do expect that regulators are going to focus more and more on this liquidity risk aspect. Even now we have seen with the FSB publication, we also have seen USCO publications, and we have a lot of discussion at European level involving EFAMA as well. And we can see that that's a big debate around the liquidity risk and what is proposed to be implemented. By talking about what is going to be implemented, we also know that soon, certainly next year, the new UCITS directive on the AFMD will be in place. And we know that basically discussions are for the moment about the fact that it will become mandatory to implement liquidity management tool at the level of management company or IFM if we're talking about alternative investment fund. And more concretely, even the proposals are going to add appendixes to those directives with a list of LMTs that can be implemented by management companies for UCITS. And on top of that, it's expected that the ESMA is going to draft some regulatory technical standards in order to clearly define for each LMT how such LMT has to be implemented, put in place, with a purpose, in fact, to harmonize those different LMT across all jurisdictions in Europe, because basically you may have the same LMT in different jurisdictions in Europe, but basically the implementation is not automatically exactly the same, and the idea is a bit to harmonize as well the thing across all the EU member states. If you can deviate as well from the UCITS world, we know there is a proposal for amending the LTIF regulation as well. And here again, liquidity risk is a key point of this amendment with the additions of new mechanisms to allow more liquidity for investors to redeem their shares. And to conclude, outside the UCITS world, even with the IFMD EU update, we know that, for example, for IF performing loan originations, clearly after a certain threshold of loan originated, it will be mandatory to be closed-ended fund in order to mitigate liquidity risk. And finally, that's what we see practically by working with our client, and especially with UCITS funds making applications for the launch of new third fund, we see that definitely at the design phase, it's really important to take into consideration the liquidity risk, and the CSSF is currently challenging more and more some application, and especially, as I mentioned previously, if we are going to talk about specific strategy with, let's say, less liquid, like investment in high-yield bond or frontier emerging market bonds, really the CSSF is challenging the liquidity risk on how it's monitored by the promoter of the fund and the investment fund manager, of course.
Yes, thanks, Alexander. I think that is indeed highlighting the importance of the liquidity risk and liquidity risk management in particular nowadays. But obviously, liquidity risk on a standalone basis, but we can't really see that on a standalone basis. There are probably also other aspects which are, let's say, coming out of that, and that turns us a bit to the valuation risk. Probably, Alexander, you can give us a bit an insight on that and how it's also a bit interlinked with the liquidity risk, which we have just been mentioning and discussing.
Yeah, exactly. When we're talking about liquidity risk, we are basically talking about the liquidity on an asset. And we know that in case of lack of liquidity of an asset, it may lead to another risk, which is a valuation risk, due to, by example, due to its low trading frequency. And if an asset we know is not frequently traded in the market, it may appear that, let's say, the last traded price or the last quote available for this asset are not necessarily relevant of the real price of the asset, and it may imply a kind of valuation risk, because at the time of an investment fund, we will want to dispose this asset. The executed price may differ from the last one which was reported and then used in the valuation of the net asset of the UCITS fund. So in such case, it's expected that the valuation of such assets must be challenged, and you cannot only rely on even if you have a listed price, is not necessarily a relevant price, and especially we have seen the case for some UCITS funds investing in index tracking certificates, that the price, even if it was listed, the price listed was not really relevant, and it was clearly not leading to a fair value of this type of certificates. So in that case, it's expected that investment fund managers are going to mitigate this risk by implementing a proper valuations methodology in order to ensure that this illiquid asset it's always valued at a fair value as required by the UCITS directive. In addition, we can also mention that the CSSF feedback report, which has been published this year as well, following the common supervisory actions on the valuation of illiquid assets. And here, clearly, it's really important for the market participant to take into consideration the different findings of the CSF on basically what is expected by the CSF from a valuation perspective. In this report, the CSF is clearly highlighting the importance to take into consideration stress market conditions when it comes to valuation of assets. And basically, what the CSF is expecting to be implemented by investment fund manager through the valuation policy, so basically by mitigating valuation risk, is to make a clear link between valuation policy on liquidity stress testing, which is part of the liquidity risk management framework for open-ended fund. As we know, as per ESMA guidelines, when we are performing liquidity stress testing, it has to be performed on both asset and liability side. And of course, when we are talking about assets, we are talking about stress testing of the market value of the asset, and in case of hypothetical or historical scenario, which have to be defined by the investment manager. But clearly, in this report, the CSF is expecting that in the valuation policy, a link is made between the liquidity stress testing policy and how it impacts the valuations. A second point is, as I said already, that clearly stress market condition must be included in the valuation process. So investment fund manager must perform some kind of stress testing, even on the valuations. And more precisely, what is important to be noted in this report is that in case we know that we may face some stress market conditions on a valuation of specific asset, of course here we're talking about illiquid one, may become not relevant anymore or not fair enough, then it has to be documented in this policy, the alternative valuation methodologies that can be employed by investment fund manager. And in fact, the CSF is also expecting that some clear criteria are defined when it comes to the change of the valuation methodology in case of stress market condition. And last but not the least, it is also expected by the CSF that IFM are going to take in consideration when it comes, again, in case of stress market conditions, if you may face some valuation issue that may ultimately lead at the end to the activations of LMT. It's something that has to be covered as well. And finally, as a reminder, following the publication of this feedback report on common supervisory action, is expected by the CSF that all investment fund managers are going to perform a gap analysis between the recommendation of the report and what is currently implemented in the valuation policy, and to fill any gap that may be discovered during this gap analysis before the year end.
Yes, yeah, there's certainly still something to be done on that. No, thanks, Alexander, for that. But obviously, as we know, risk management, it's an overall risk approach which we have to apply. So we have been speaking now about liquidity risk, valuation risks, what are in fact, let's say, the other important risks which in particular the CSSF is looking at nowadays?
Well, we all know that last year in August, UCITS directive has been updated as well with the IFM directive, and now sustainability risk is part of the material risk that must be integrated in the risk management framework of investment fund manager. So the CSSF performed a thematic review on the implementation of sustainability-related provision in the investment fund industry. So this thematic review was covering different aspects, including SFDR disclosure, but one part of this review was also concerning sustainability risk. And definitely it clarifies that really the CSSF is expecting a proper integration for sustainability risk management into the global risk management framework. And here we really have to keep in mind that we are not talking about only Article 8 or 9 funds, but we are talking about all funds under management, as sustainability risk is considered as to be a material risk, which needs to be properly monitored. So, as a consequence, integrated into the risk management framework of the IFM. In that sense, it is expected that investment fund managers are defining some key risk indicators to be monitored across all the funds under management. Here again, whatever the fund is not a product approach, but clearly a risk approach that has to cover all the funds under management. And of course, as we are defining some key risk indicators, some specific internal limit must be also defined by the permanent risk management function and to be monitored as part of the regular risk monitoring, and as it is performed for any other risk like market, liquidity or credit risk. And one point, but not the least, it is clearly stated in this review that relying only on the investment criteria, integrating some sustainability factors, is not sufficient to be considered as a proper risk management. So in that sense, for example, a simple use of exclusion list may not be necessarily a relevant way to monitor sustainability risk, and it is expected that additional monitoring and processes are in place, especially for sustainability risk.
Mm-hmm. Well, thanks, Alexander, for these insights. I think that is really a topic which is obviously going forward, a very, very important one. And we have one element at the end, investment restrictions risk, and can you also make a bit the combination with sustainability risk, and how can that be translated into some investment restrictions risk?
Yeah, so basically following this thematic review and based on the experience and some cases we had recently, we see that the CSSF is having more and more scrutiny on all the aspect of the contractual disclosure. So here we're talking about pre-contractual disclosure and periodical disclosure, and yes, the trend that we see is that it's maybe to consider that any pre-contractual disclosure maybe, let's say, be binding, and it may lead potentially to an investment restriction risk in case they are not respected. So basically, we have seen the CSSF challenging some of our clients in case you have some pre-contractual disclosure which are indeed disclosed to the investors, and when they are going to make a comparison with a periodical one, any gap between both of them may be potentially interpreted as an investment restriction breach. So this is clearly a point that it's really have to keep that all the market participants, investment manager, have to keep in mind. And we also know that for the moment, CSSF is working on the revamp of the circular 0277, and it will be very important to keep in mind and to draw attention on what is going to be stated in the new versions, especially with regard to investment restriction related to sustainable aspects. That it may be possible that it will become it will fall under the scope of this circular. So meaning any restrictions, ESG restriction defined in the prospectus will be considered as investment risk is not respected and falling under the scope of the 0277, and then of course implying the concept of passive active breaches, and that may lead to the compensation to the fund by the investment fund manager.
Well, thanks, Alexander, for that. Obviously, we have to, let's say, follow still very closely the developments on that, and then Right, but that was, let's say, the topic of sustainability risk. Now, let's say, obviously, a UCITS fund can invest in a number of different investment instruments. The one might have, let's say, more risk associated with than compared to another one. And we just wanted to pick one specific instrument here, focus on contingent convertible bonds. Alexander, what could we mention here from a risk management perspective? What is in fact the specific focus which we have to highlight?
Well, basically we decided to focus on contingent convertible bond because as we know at the beginning of the year with the purchase of Credit Suisse by UBS, we have seen that there has been forced conversions of convertible bonds issued by Credit Suisse, and this conversion has been forced by the regulator. So clearly that's a risk that has to be considered when investing in such instruments, and just we wanted a bit to highlight what are the expectations of the CSSF in this regard. We know that in case a UCITS fund is going to invest a significant part of its asset into contingent convertible bonds, so basically more than 20% of its asset, then the CSSF is expecting additional risk process in place, and especially for covering the contingent convertible bond. And what is expected by the CSSF is that the investment fund manager of such fund are really integrating into their risk management process the risk related to the conversion mechanisms of this instrument. So basically it's expected that the risk management framework of this investment fund manager or management company for UCITS integrates the triggering risk monitoring in this process. So basically it is important to note that the CSSF expects that the distance to trigger is properly monitored for the investment made into cocoa bonds of those funds. And in addition, it has expected that the investment fund manager can demonstrate that he is assessing the expected loss that may occur in case of conversions of the cocoa bonds held in the portfolio. But as well, it's expected that the investment fund manager is able to properly assess the risk of what we call the point of non-viability, and definitely here we are talking about the fact that when the ratios of financial institutions are not good enough, it's a conversion which is forced by the regulator. So basically when monitoring the triggering risk of contingent convertible bonds, it is important to develop a proper risk management process, and we have seen that several models can be defined. And of course, when performing this assessment, it is important to take into consideration the specific characteristics of those contingent convertible bonds. So here, I mean, we have to take into consideration the different mechanisms of conversions that we may have. You may have a partial or total write-down, or we can also have an equity conversions of those instruments. Sometimes you may have a floor price as well, which has to be taken into considerations. And clearly, CSSF is expecting that all those characteristics of the contingent convertible bonds that you may have are covered in the risk management process on the model you will put in place. And then definitely, yes, what is also expected when you are defining this kind of model to monitor the expected loss that you may face when, in case of conversions of the cocoa bonds that you are holding in portfolio, is that you also make such assessment in case of straight market condition. So here again, we are always circling with the stress market condition, even if we are talking liquidity risk, valuation risk, or here on contingent convertible bonds. That's clearly a clear point that it is expected to be monitored by investment fund manager to be taken into considerations when assessing the different risks. Of course, on top of the triggering risk, it's also expected by the CSSF that a proper monitoring of the valuation risk, credit risk, and liquidity risk associated to contingent convertible bond, it's also performed by the investment fund manager. But definitely, with regard to the triggering risk, which is really specific to contingent convertible bond, when a UCITS fund invests a significant part of its asset in such instruments, it's really expecting to have in place a proper monitoring process.
Yes, no, thanks, Alexander. That should give us a bit, let's say, focus on these specific assets. I've been covering, let's say, some topics, liquidity risk, valuation risk, sustainability risk, and this more specific focus on the contingent convertible bonds. Now we wanted to open a bit the floor, in fact, to the audience for further, let's say, question. And further of all, obviously, I want to apologize for the beginning. I think we had a bit of a technical issue at the very beginning, and that was a bit of a practical risk management in that sense. But with that, I just wanted to open it a bit to the audience in terms of questions. And I can just have a look here in parallel. Yeah, probably, Alexander, one question which I think is a very good one in terms of, but we have been speaking about sustainability risk. We have the risk management framework, as we know. How, in fact, can that be best integrated? I think that's a very practical question and an important one. How can the sustainability risk be implemented into the overall risk management framework?
Yeah, so far in the market, sustainability risk is really challenging because it's clearly a new risk that investment fund manager must take into consideration in the risk management framework, and there is no clear standard model to be used for the moment. But anyway, we know that as it's a material risk, like market or credit risk, it has to be fully integrated in the, let's say, normal risk management framework. And basically what is expecting is when we are doing, for example, the risk profiling of a fund, that of course it is expected that some specific key risk indicators are going to be defined for sustainability risk and for the monitoring of them. And the methodology that must be employed is first to perform, let's say, what we call a materiality assessment on the mapping of the investment of the fund, and to try to determine the different sustainability risks that the fund may face. We are talking about transition risk, physical risk, and based on this initial mapping and materiality assessment, just by considering the most relevant one, it is expected that the investment fund manager are going to define some key risk indicators. Those key risk indicators, they must be quantitative or qualitative. Of course, once defined from a risk management perspective, some internal limits must be defined and monitored on a regular basis. Here, what is important to note is that when defining and choosing a key risk indicators, it's important to ensure that the investment fund manager have access to the adequate information on the data to monitor them in a proper way. Of course, for UCITS, we are talking about listed instrument, and we know that the main service data provider are providing large amount of data for listed securities. But anyway, it's important to take that into consideration in order to ensure that you define key risk indicators for which you have the data for at least almost all the assets in which your UCITS fund under management are investing. And as I say, when you have defined the key risk indicator, you have to define internal limit, and as any other internal limit, of course, a remediation and escalation is expected, and clearly the risk reporting channel for sustainability risk must follow the same as you have for market, credit, or liquidity risk. And last but not the least, it may be also expected that if relevant, some stress testing must be applied as well on the sustainability risk indicators. Of course, here it's a bit even more challenging, especially when we are going to talk about qualitative risk indicators, but it's something that may be implemented as well.
Okay, no, I think that's obviously a lot what has to be tackled here. No, thanks, Alexander, for that. Probably another question is, where we had the liquidity risk, let's say, considerations. But what other consequences may have liquidity risk on an asset for UCITS, Alexander?
So, as we have seen a bit earlier in our webinar, of course, the first one we already mentioned is that, okay, if you have a high liquidity risk, so meaning that an asset may be illiquid, you may face a valuation risk. So here, basically, depending on the concentration of the asset invested in this specific asset or instrument, then you may face a valuation risk, and potentially, as we are in the UCITS world, you may trigger NAV error when computing it. So that's basically the main risk that you are facing. But another one which has to be taken into consideration is clearly if you have a high liquidity risk, meaning that the securities is not liquid at all. Here you may face another risk, is that definitely as the security is not liquid, basically you may fail to meet all the eligible criteria for transferable security for UCITS. And basically, ultimately, if you are not able to demonstrate the liquidity of this security, you may lead to an investment breach related to the fact that, in fact, the security is not eligible for UCITS investment. And that's some points that we have encountered with some clients. And really, we have seen that the CSSF is challenging more and more on the liquidity aspect, especially for UCITS fund and for specific instruments. Of course, as I already mentioned, sometimes it's related to some index tracking certificates, which are eligible for UCITS, but of course, the liquidity aspect is really important, and we have seen that the CSSF has a strict view on that, and if the liquidity of this instrument is cannot be demonstrated, it's considered as a non-eligible asset for UCITS, and then, of course, it's falling under the scope of the Circular 0277, and it may be considered as well as an active breach if the liquidity was not even demonstrated at the time of the investment.
Yes, no, thanks, Alexander. I think that is, you see how in fact all these different elements have to be tackled together. But if I see that were probably the questions which we had, and obviously I think looking here at the audience, I think thank you very much for attending and for the questions which you had. And I think we are obviously looking forward, Alexander and myself, and also the whole Arendt team, to continue, in fact, the webinar series on UCITS. And probably, Alexander, we can sit again here next year and address the, let's say, new developments in terms of risk management, and hopefully in a better, let's say, world about it. And let's see. Thank you very much for attending, and have a good rest of the day.
Thank you very much.